It was hosted by the SIRC of ICA under the aegis of Committee on Financial Markets and Investors Protection. At the heart of today's program, we are delighted to welcome a distinguished professional and a respected member of Chartered Accountant community, CA Rajkumar Bafna S. Sir, I request you to occupy this chair, sir. Before we begin, I request the members to rise up for the motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैत
Thank you. Before we move on, I'd like to have a short, brief summary about our speaker, CA Rajkumar Bafna S. As a fellow chartered accountant, he has established a commendable track record in the areas of audit and assurance, direct and indirect taxation, and forensic accounting. He is a certified professional in forensic accounting and fraud detection, and he also brings with him not only technical expertise, but a different perspective on financial innovation and investment strategies, particularly in unlisted and long-term value investing. Currently serving as the president of the Association of Chartered Accountants, Chennai, he leads a network of over 500 professionals. He has also been a much sought after speaker and has contributed meaningfully to knowledge sharing across platforms. He is also a recipient of several accolades, including rare distinction of being featured on the Wall of Visionaries by Visionaries Charitable Trust. On behalf of SIRC and everyone present, I extend our warmest welcome to CA Rajkumar Bafna sir, and we are truly privileged to have him with him today. As a token of gratitude and respect, I now invite CA A.R. Venkatramana sir to give away the memento to our speaker.
He was my once old student here in our SIRC.
Thank you. So without further ado, I now request CA Rajkumar Bafna sir to take over the session. Thank you, sir.
A very happy evening to one and all present here, respected seniors members, fellow colleagues and special invitees. I welcome you all for the knowledge session over here. First and foremost, special thanks to our chairperson, SIRC chairperson, Revati Raghunathan ma'am, for giving this opportunity. And this is my first presentation in institute as such. I've given in various other forums, but speaking at institute is the first chance, and special thanks to ma'am for that. And we'll straight away start with our presentation for the day. Coming on a Friday evening and seeing a great audience today, it gives a encouragement to speak on a topic which is most passionate to me. We'll keep it light and delight. As and when if you have any queries or subject matter to be discussed, we'll take it then and there. nothing specific that it will be taken up at the end of the session. We are all here. We are all here to understand the various strategies. How investment starts? How investment starts? It starts basically from income. Only when you have quality of income and a scope where you can invest, where you can save after your expenses, you will think about investment. This is the first and foremost rule. You should develop on your regular income so that you save after your regular expenses. So how you will develop your incomes? So one is your regular income, and second one will be most important, will be where we don't generally focus, is your passive income. Passive income is something which you don't put day-to-day efforts for earning that passive income. You will put that effort only once or twice, and it will automatically give you a regular income. For your regular income, you need to go, if you are a job person, in a salaried employed, you need to work daily. If you are a businessman, you have to go to office daily. But passive income is something which you are working for once or twice in your lifetime, and you get a recurring income from that. So having a passive income is a scope for financial freedom. So how many of you have passive income as good as your regular income? This is something which you should ask yourself. Suppose your regular income is 1 lakh or 10 lakhs per month. What is your passive income which you get without working? If you have equal amount of income as good as your regular income, you are as good as financial freedom, that you don't have any pressure to go to day-to-day working style. If not, if you don't have a passive income, it is something like you have to compulsory work and earn that money. So once you are extra aware of the passive income, your investing style will change, your risk-taking appetite will obviously increase. What are various forms of passive income? Somebody? Rental income, yes. Dividend interest, yes. Those are consistent passive income. How about variable passive incomes, which will vary, which may not be same? Systematic withdrawal plan. Capital gains. Capital gain is something which we are all here today. Basically, when we say about investment, it is mostly focused on equities. So, and we are all here to discuss the chapter income from capital gains. So we are not here to discuss income from house property or business income. Basically, we are here to understand the significance of the capital gains, from where all we can get capital gains and best of the returns from the investments. A simple funda, staying long term in the market will give you bigger returns. This funda, we have to be very clear in respect of being. I'm saying a couple of senior members, they will acknowledge this statement. If you are in market for more than 15 years, 20 years, obviously you would have made a wealth which is much more than a person who is in equity for 2 or 3 years. So you have to stay in the market for a couple of years. And how do we make it big in the market? This is the next question which I have to ask to you. How do we make big in the market? Simple, and just to start, how do we make the big? Anyone? We all want to make a big portfolio, right? Small quantity, accumulating it. Yes. I want it to be interactive so that we get the best out of everyone and get a presentable evening. Yes, Pranav bhai. Anything? SIPs, that is, day-to-day investment on a systematic, consistent manner. Yes. To me, how do we make it big is by getting it prepared. A good mindset will get you dream big, and obviously once you dream big, you will be achieving big. And as Charlie Munger said, opportunities comes to the prepared mind. Opportunities come to the prepared mind, and investment success isn't about luck. We all try our luck in the market, but it is not about the luck. It's about the preparation. Only those who have done homework can truly benefit. And after investing in a particular share, how many of you consistently review that share? It is not that you open money control on a daily basis, see that pricing of the shares daily on 3 to 4 times in a day. That is not continuously watching it. It is just seeing, and you are not reading about the company. How many of you genuinely track the company with regards to its working, annual reports, con call, and other things? Most of you will have at least 20 to 50 companies in your portfolio. And can you just say any one company which you are tracking 100% that I know it is going to do in next quarter so and so? That is the lack of preparation which we have, and it is as good as we are investing in the company, we are investing in that business. Suppose leave that company because that is a lot bigger market cap. We don't have a role in day-to-day business activity and decision making. Just suppose that you and me are starting a business. We both are partners. You are an investing partner and I am a working partner. You have invested money and I am working. Okay, as a director I am working in that company and you are just an investing partner. Will you not keep a track on my day-to-day activity? Yes. So same is that. Our portion of capital will be 0.001% in equity, but in partnership firm we can say 20%, 50%, whatever. Because our share is more, we will focus more in partnership firm. When our share of investment is less, we tend to give less time to that investment. But value wise, here also we are investing 10 lakhs, 50 lakhs, there also we are investing 10 lakhs, 50 lakhs. But the concept and the mindset is entirely different when it comes to share and partnership firm. Money remaining the same, amount remaining the same, but the concept of mindset that here partnership firm I can ask directly, but in a company I cannot ask, so I'm least bothered and I'm not tracking that company. But foremost, in a partnership firm, you will get information only when you are in day-to-day activities. But in companies, if you attend AGMs, con calls, and other quarterly results, you will be much more aware of the company about it and your conviction will develop. So we have to prepare ourselves for the opportunities which we are getting. I basically follow the first rule of investing. We have seniors, I have people with the age of 20 also. Just I spoke to that girl. This is the first rule for you which you should be focusing on. A goal-based investing has to be there. Okay, when you are starting your investment journey, you should be having a goal for what you are actually starting your investments. Start your investment journey with asking yourself why. Why do I need to invest? For today's journey, it is the need of the hour. It's not working. It's the need of the hour. Investing without a goal is like shooting without the target. So we are just, because I'm started earning 20,000 a month, I'm investing 10,000 a month. So that is one part and it is good sign, but we don't have any target as such. Why we are investing, where we are investing. A structured planning will help you achieve much more faster than just randomly investing. Then next is, when do we start? Today. Today is the best day to start. At the age of 20 is also good, at the age of 35 is also good, at the age of 50, at the age of 70, any day is good to start investing. Only thing is, focused investing is needed with a desired goal. You don't have to be rich to invest, but you have to invest to be rich. You don't have to be rich to invest. Today, even if you are not rich, no issues. But to get rich, you have to invest only. Because working in a job or a business will certainly give you good amount of freedom in capital raising, but investment will give much more faster in a longer run. After 10 years, 15 years, you will learn equally of what you are earning in your business. So you will have two income, your regular business income as well as your passive income from investing. How do you invest? By taking actions. When you have decided to start investing today, you have to start taking action. Only by reading or only by doing so, it will not help. We have to start taking action. Small steps, obviously SIPs and accumulating on a smaller 1 share, 5 share, 10 shares of a quality stock will obviously help you make a big portfolio. So it is by taking action, and investing is not a journey of a 100-meter race. It is a journey of running a marathon. So it is a bigger race where you should not run with emotion, you should run with strategy. So it is like a marathon race where you need to have a lot of strength, strategies, rather than going with the emotion of going faster and just completing in a race in a faster way. We have long duration. Person starting at a 20-year age, at least you have 40-50 years to invest and make a bigger portfolio. Your consistent investment for 15 to 20 years, your next generation, when the next generation comes in your life, you will be much more settled and there is no need to look back. And when we say it has to be a goal-based investing, how a goal has to be? Take care of your capital, retirement. So one thing is your retirement. That is the goal, that I should be having enough capital on my retirement. Economic development of the country. Yes, that is also a point of view, that if I invest, it will be developing my economic growth of my country. Yes, sir. Yes, independency of non-availability of a person, earning person. If I am not there, my family should not get disturbed financially. So that is the point which he is saying. For that, what is the tool? Insurance. Insurance is the best tool. When an earning member is not there in the family, in absence of the earning member, insurance plays a vital role, where we can get a ample of sum assured, which will at least give 2 to 3 years of backup, and the mindset, obviously by time it will change and the family will have a next generation to lead the show. To me, a goal has to be SMART. SMART means S for specific. It has to be specific with a purpose defined. As Sir said, it has to be for retirement. I believe in next generation wealth creation. So everybody will have different point of expectation and the goal setup, but one should specifically have a goal, and a desired goal will obviously help you to it will give a backup push that I have to achieve that. It has to be measurable. What I need, how much I need, it has to be specifically measurable, so that that's what I said now. It will be very easy for us to achieve. We have to go backward calculative. I need 10 crores after 10 years. So how much should I invest today? At what rate should I go? So all those will be helping tool for us to understand our day-to-day investing style. Achievable. If I can say I need 100 crores, will it be achievable? If I invest only 10,000 today and I want 100 crores in 10 years, it is not achievable. So it has to be achievable, approachable and realistic. Next is realistic, to match with my target goal and in time bound. If I can achieve 100 crores after I attain 80, is no use. I should enjoy the wealth which I generate. In my lifetime, if I can generate at the age of 45, 50, I can enjoy that wealth, I can pass on to my next generation. What if I use it at 80? My next generation is also there and my third generation will also be there. That wealth is of not of enjoyable. It is a wealth, but we will not be enjoying that wealth. This framework will bring us a structure and clarity to our investment plan. This is the most important journey which I believe. It is not a one basket investment. It should not be a one basket investment at all. Yes, and I have made it as a creditability. As Pranav Bhai said, that it has to be our family depends on our earning, so it is our credibility to stand for the absence of ourselves. When we are absent, it has to take care by the financial need. So it is the cred diversified portfolio basically has 4 structures: the commodity, real estate, equity and debt. So in commodity, I personally feel generally it is considered to be large for inflation, beating the inflation, but whereas in last 2-3 years, if we see the returns, it has outperformed all the major class of assets. So one should have diversified portfolio, and there are ample number of opportunities where gold and silvers are giving decent and much more returns than the stock as such. The standard returns in mutual fund we consider as 15 to 18%, but in last 2 years the bullions have given roughly around 20 to 25% return. Even in last 3-4 days it has given 5 to 6%. Getting 5 to 6% in a week is dream for a year in last 10 years back in bullion. So that is the concept. Because of the trade wars and the other economic affairs happening all over the world, so scarcity of the bullions and the materials will obviously there, and usage of the silver in all the EV semiconductors, the usage has increased more, so thus the demand has increased. So obviously a silver as a tool to leverage over others diversified asset is the best tool which I believe. Next is real estate. We generally tend to see that real estate means a bigger capital. We need bigger capital to invest in real estate, so we go for the easiest method is equity. If I have 1,000 also, I will put in SIP. If I have 50,000 also, I will see equity. If I have 5 lakhs also, first we intend to do only equity. We don't create FD. We don't go and buy half kg of silver also in 50,000. But first intention will be, I have 50,000 extra, I will invest in equity. Do you agree or not? Most of us, 90% of us, if you have 50,000 also, we will just intend to invest in equity than any other asset. So the real estate part will come after covering all the 3 assets. You should have ample amount of bullion, you should have ample amount of portfolio sizing and your debt, that is FD and other safest investments. So equity, I believe it is for risk takers. High risk gives high rewards. On a longer run, on a safer side, if you plan your entry point, if you are good at giving an entry point, even it on a higher value also, but if you have invested in a quality stock and if you remain to be with it for 10-15 years, certainly you will make much more than any of the other asset class. But by combining this, you are not relying on one asset class, but a diversified portfolio will help you average all the day-to-day, year-on-year return to you. This is the best thing which I feel most of us don't work on. The matrix of reward. The best thing which we should learn in investing is risk management. There are 4 possible chances. If we take a trade today, what things can happen? These are the 4 elements. I can earn a small profit, a small loss, a big profit or a big loss. Exactly? Or any other situation apart from this? What is the maximum amount of loss which we can see in the market? I have invested 1 lakh today. What is the maximum loss I can see in the market? 1 lakh. So I can guarantee my loss that it will be only to the amount of investment. Can I say I can earn only 1 lakh from that investment? It is not in my hands. Return is in the hand of market, loss is in the hand of my own self. So you have to invest, that is the risk management. The quality of amount what you invest, the quantity of the amount you invest, it is depending on our risk appetite. It is as good as foregoing that amount. If you can just forego that amount, so you will be risk free of taking it as that it is not my money and giving time to it to develop. Obviously it will give you much longer returns. So which matrix we all should focus? Big profit, big loss, small profit, small loss. What do we all want? Small profit, small loss, big loss. Big profit. And do we generally sell our best winners at small profits? We are getting 20% in 1 month. We intend to sell. Is it true or not? How many of you sell a stock if it raises by 20% in a month? Though you have, at the time of investment, you wanted it to be a long term, and immediately after buying in 2 days, last 2 days, NSDL has gone 20%. So we bought it for long term, but in 2 days, we are getting 30%. How many of you intend to sell that? Irrespective of your vision of having long term. We intend to sell. Generally, we intend to book profit. Yes, sir. Correct, sir. No, understand, but no, it is that, sir. But I am just asking with regards to investment in NSDL at 900. We intended to keep it for a long term, but in 2 days, if we get 30%, first thing which we do is to sell that to book profit. We will see another stock. We will keep other things. The same way, if a stock goes 30% down in 2 days, do we intend to sell? No, we will give time to it to redevelop. So that is a mindset game which we need to focus and develop things. So only thing which we have to focus is avoid big losses. Once we start developing how to avoid big losses, obviously what it need to be done is the fourth matrix. We have to avoid big losses. And to a general term, what a big loss means, 2% downfall in an index. Just today, suppose Nifty has fallen 500 points. So it is 2% fall, and 2% fall in last 17 years has happened only 120 days. Out of 4,500 working days, only 120 days were more than 2% fall. So we have to take care of only 120 days out of 4,500 days. And we have to remain invested for 4,500 days, take care of 120 days. That's it. 3% of our emotion we have to control, and 97% we will automatically get the best out of it. That is the only mindset game which we have to develop, and it will come over time. This is what we need to focus to develop our mindset. The ratio, slagging ratio. It is nothing but number of trades which we do. We have to just do a self-evaluation. Last 10 trades which you have done, just take out your last 10 trades, whether it has worked according to my ambition or something like that, my targets have been achieved or not, whether it has been achieved in the desired time or not. So it has to be the correct trade versus the wrong trade. So out of the last 10 trades which you have made, if your 6 or 7 trades are in your favor, you are doing a fair enough job. What you thought and you are doing the right way, it is a fair enough job. If you can just improve this ratio, if your good trades are only 2 to 3 and all your trades are just moving above the cost or in and around the cost, then it is no point in investing in equity. Go to a debt market, invest for 7 to 8%. That will be good enough without any risk appetite. So if you want a return of 8 to 10%, debt is a much more safer investment than coming to equity. You will say, I am earning 5% on the equity for last 1 year, but that is not the return at which you are investing in equity. General equity returns which we expect is 15 to 18%. If we can get in equity, it is a fair enough of return expectations where we are putting our money in equity for a 15% return. So we have to understand the ratio at which we are working. So if once we achieve this, how many of you have this 2:1 ratio? Anyone? Out of your last 10 trades, if you can have 7 positive trades. Anyone in the audience? Sir is by his experience, he is able to do it. It has come, 3:1 also. Yes, good sir. So it is by experience, it will come by experience, but this has to be our target. It is not that from the day one, if I'm making a trade, it has to be positive only. Only when you make negative trades, you will learn from it. But having learned, next time you should not continue to do this. And most important, allocate more funds to your winner than to your losers. Suppose my 7 trades are good. Okay, I'm investing 1 lakh in 7 trades, and my 3 trades are bad where I'm investing 5 lakhs. So 5 into 3 is 50, and 7 into 1 is 7 lakhs. My 7 lakhs is doing decently 50% return. I'm getting 3.5 lakhs, but my 15 lakhs, 3 wrong trades, but where have I invested more? And 20% downfall from that is also loss of 3 lakhs. So 50% gain is compensated by 20% loss also. So this is something which we need to evaluate, and the portfolio sizing matters a lot when you go for this risk reward strategy. You have to go focus on your portfolio sizing. You have to allocate more to your winners. This is something where long-term investing plays a major role, the power of compounding. And seed means to be fortunate to get the power of compounding. The best way is to start early. And today is also the best day. Even if I'm starting at 35, it is the best day to start, because it is never late to start investing. But having realized that investment is something big which will help me in my retirement, we should start at the earliest. Evolution. We should be adaptive to change. In SIRC's time, agriculture was the sector which India was looking at. In 90s, service sector came up. Now in 2020s, the defense sector has boomed. Now manufacturing sectors will boom. India will be known for evolutions. So we have to be adaptive, and the change has to come over a period of time. As sir said, how Indian economy grows, we have to change our portfolio accordingly. I should not continue with the technology alone, which was 91 theme, IT sector. I should not continue to remain 50% of my portfolio sizing should not be in tech, because the sector has evolved. And now the new sectors as defense sectors, chemical sectors. So I should also shift my focus on the upcoming sectors. In long run, only those kind of things will help you create more wealth. Sticking around in a single company, it is something like loving a single company. Obviously, it will give you a faster return or a bigger wealth. But at a point of time, you should exit it partially also, and to invest in another new companies. Avoid. What we should avoid? Cheap is always not good. You are getting something for cheap which I didn't desire to buy. I didn't have in my watch list. Just because it has fallen. Something has fallen for 30%, 40% in a month. I should not go and buy. If it was in my watch list and if I wanted it to buy and it has fallen 30%, I should grab the opportunity. My intention was to buy for 1 lakh, and if it has fallen 30%, I should buy for 2 lakhs. It was in my watch list, I should grab it. But it was not in my watch list, and just because it has fallen or somebody else has told me, there is no point in, that will not match your goal strategy. And the fourth and the most important is the discipline and being focused. Your consistent investing strategy, being disciplined in the market, learning it for the company, attending those AGMs, con calls, will have you, giving you conviction, obviously, and your conviction will only help you when to buy, when to sell, and how long to hold. These are the only 3 calls which we have to make. Should I buy? Should I sell? Or should I continue to hold? Any other options? Buy, sell, and hold are the 3 decisions which we have to make, and it will be supported only by understanding about the company. Compounding is the magic where you earned money, earning returns on your returns. This is something, earning extra return on your returns. This is compounding. And how compounding works, I will just give you a next slide. simple method. Is it every year can we achieve, every year can we double our money? Is it possible in equity? No. No, no, sir. Chalo. 50% achievable. Every year, if I invest 1 lakh, I can make 50,000. Next year, I can make 75,000. I can achieve 50%. With my consistency, I can achieve 50%. Is sir is telling. Average, we intend to invest with a principle of 15 to 20%. Okay, sir. So 100 rupees will be 120 at the end of the year. Second year, it will be 144. 24 increase, so 144. Okay. One more logic which I am going to give you. Can we get 5% every month? How many of you do swing trading? Swing trading, yes. The concept is coming up with a Techno-funda concept is there, where it is like catching the fundamental stock technically. A good quality A category stock is available on a momentum by seeing it technically. So both fundamental and technical will help you to get the momentum of it. So while investing itself, you know that it is for my 1 month duration and I am catching that momentum. The sudden spike, I want to catch that. So it is Techno-funda investing where I can get more than 5 to 10% in a month in a quality stock. I am not talking about penny stock or a circuit stock where it is only on continuous circuits. Quality stocks also give 5 to 10% every month. Even Reliance also or SBI also, it is trading at 800. We can see 760 also, 840 also. It is in that range only. We can catch the 5%. Every month we can catch that 5% without going into F&O, without going into margin money. I am not into suggestion of those kind of returns where we are investing less and getting more. Simple investing 1 lakh rupee and getting 5,000 every month. Is it achievable? Every month it is achievable. One trade, 5% trade, we can do it. Okay. So if we continue to do those 12 trades in that year, what will be the return? With compounding, it will be 78%. 5% every month, compounding for 12 months, it is 78%. If we set for one return, it is 20%. And if I keep compounding, I am booking profit for 5%. 12 trades will give me 78%. And if I continue for 5 years, that is 60 months, what will be my returns? 1 lakh will be 4.34. 1 lakh will become 4,34,000. Chalo, it is not possible for me to get every month 5%. Okay. Even if I get 30 good trades, I am not selling those stock because it is a quality stock. Today I am buying. If you grow 1 lakh by 5% every month for next 60 months, 5 years, the final amount will be 18 lakhs. All your 60 trades are going in your favor. 1 lakh become 1 lakh 5,000. Next month 1 lakh 5,000 becomes 1 lakh 5,500 something, and it goes on. All your 60 trades are in your favor. The final amount will be 18.67. Believable? Achievable? With just 5% return every month. Can we get it? Simple funda. Chalo, we are not favorable or fortunate enough to get all the 60 trades in my favor. Okay. Where we are investing? We are investing in a technically fundamental stock. Okay. It may take 2 months also to get that 5%. I will continue to remain invested in that stock. Okay. And that 1 month I am not selling it, I will sell in the second month. So if assuming I made only 30 trades, assuming our slugging ratio is half, 30 trades I am able to do 5%, still I will be making 4.32. Yes, sir. 10 technical stock. Okay, sir. Average you have to take, sir. Another 2 will be 2%, another 3 will be negative 10%. Average of that on a 10 stocks, I should get 5%. There will be stocks which will get 10% also. So my average monthly return has to be 5%. Overall. 10 lakhs you are having, you are investing 1 lakh each. Okay. Average on all the 10 lakhs, 10 stocks, I should get 50,000. Minimum things. Not possible, but it is possible. And I have made it. Simple formula, it can be done, it will come over a time. Chalo. Which is nothing but 34% CAGR. Even after 30 trades in 5 years of 5%, I will be getting a CAGR of 34%, which is almost double than the regular expected equity returns. The art to learn the max is to learn swing trading. It is catching the fundamental good stock technically to gain the momentum gain. So what we have to focus is Techno-funda. There is a new concept where we all can research ourselves. Techno-funda, catching the fundamental stock technically to gain the momentum. What we have to do, how many of you use Stock Edge or Screener? These are the quality apps which gives us all the investors direct reporting rather than going into BSE side, catching one by one and all the other things. In Stock Edge, there is a concept called volume seekers. They will give everyday reporting on volumes. Yesterday the volume in a stock was 1 lakh, or in a month it was 1 lakh, but suddenly it got traded for 20 lakhs. Average volume was 1 lakh, 1 lakh share gets traded, and suddenly today 20 lakh shares were traded, and with a upper circuit. We have to catch only those. We have to go understand the situation, who has invested today, which mutual fund has invested, or 20 lakh volume is reported, sir. It is available. I am not able to hear you, sir. Yes, at the end of the day, sir, not today, sir. Yesterday it was 1 lakh.
Sir, yesterday it was 1 lakh, sir.
1 lakh, and average monthly average was also 1 lakh, sir. Okay, today it got traded of 20 lakhs. I am not taking decision today. Today night I am studying. Okay, not during the market time. Today after 5 o'clock, I will get the report that the volumes rose to 20x of his daily and monthly average. Okay, then I have to go there, see who has invested today, which mutual fund has shown interest, or which anchor investor or a big person has invested today. What is the reason for raise in volume? You will get the answer by yourself. Yesterday you can open, sir. You can open and see. I can show you also. So volume seeker is something where you can catch for momentum gain. Then you have to see whether the companies have fundamentally strong or not. Again, we have to do all those reviews, filter many things, whether ROI is there, P is there, all those things I am going to take. But this is just the small catch where how to catch a momentum thing. So can we get 5% every month? We will try, sir. For next 1 year, if we can get 6 trades also, and then 5 years, we will be having 4.34 in our packet, which is 34% CAGR. This will help us, sir, how to understand the fundamental stocks. This is after lot of research and things, I have given an abbreviation for the index. Where do we invest in index stocks? So for me, index means incremental. What we should see in a company? A company should have an incremental ROCE, return on capital employed. Revenue should grow. Operating margin should grow. A growing if you invest in a growing company, obviously you will also grow. By being with a good person, you will obviously become a good person. Same is by being with a good company, you will obviously grow with the company. So what we need to see is the incremental side of the company. then it is the net worth. Investing in a 100 crore company will obviously give you less confidence than investing in a 10,000 market crore capital, because the 10,000 market company will not evolve in 1 or 2 days. It will not run off. It will take its own time to dilute or something like that, whereas 100 crore market cap can vanish tomorrow also. So that confidence will give only after 5,000, 10,000 market cap, so we can sustain and remain invested. So that satisfaction will come only when you have good net worth in the company. And to me, a net worth means not just capital. I may have 1,000 rupees share capital, it is by premium received by subscription. That is not the money which company has earned. What we should say is the cash reserve surplus in P&L. How much profit it has generated over a period of time. The capacity of earning will depend on the cash reserve and the surplus of the P&L. In reserves and surplus, there will be revaluation reserves, securities premium, other things also will be there. But a company actually growing will have a good quality of surplus in P&L. Every year it is accumulating its profit. That will only give you good dividend and bonus also. Not from the securities premium. I have only received from you and I will not give you bonus from that. What I have earned on a year-on-year basis, only from there only I can give you bonus. So what we need to focus is the surplus on P&L. D stand for development in capex. The company wishes to grow substantially in new manufacturing unit or acquiring some new business, something like that will give you increase in the capacity building. So those things will obviously, today I am developing my capacity, from that capacity I will be earning next year onwards. So obviously the development will help me in my first point, increase in revenue. Incremental concept. E stand for earning. Q on Q growth, quarter on quarter growth. We have to just monitor quarterly results, okay? And bigger companies nowadays has con calls every month or every fortnight with investors. Please attend. I assume everyone has 20 to 50 stocks in your portfolio. Just have a watch list, okay? Go to investor con calls. Companies which are having con calls recently, just go and download the PDF. Once you download the PDF, most of you will be using ChatGPTs. No need to read all the 50 pages, 20 pages, nothing required. Download and put it in ChatGPT. It will give you a crisp fundamental of what has been company telling, what questions have been asked, what the company is telling. In 10 pointers, we will understand how the company is going forward. Those use of text can be done and we can use those things. X factor is most important. When all the companies are doing the same service, will I get a different return? No. I need to go for a X factor in that company. Like a chemical company, which is only supplying to a single pharma. Without it, if medicine cannot be made. So it is the X factor. We have to find those X factors which will help us to do that. Yes, sir? Unable to hear, sir. Contingent factor, no, sir. Unique factor. Unique factor, sir. You and me are doing the same services, sir. You are also doing tax audit. I am also doing tax audit, sir. If a third person wants to come, both are doing same service at a same fee, he can come to anyone. I should have some specialization so that I can give a extra service, then only my revenue will increase. So we have to see a specialized company. That is the X factor. The 4 buckets of stocks investments. By going into the last slide, how we see the company, how we should pick a company. This is my strategy to create for value pick. Because in a long run, value pick will give 1000x also, okay, rather than going for growth or compounder. Compounder will go at 20%, 15%, which is also good because we saw the power of 5% giving us 4x in 5 years. So why not? That is also there, but a value pick is more percentage wise will get more return than this. Anyways, we should not only focus on value pick because it may not also give these expected returns. So in that also we have to be diversified in our portfolio to get a growth business, compounder stock, value stock and a turnaround stock. Turnaround is something a business is doing poor, but today suddenly I am acquiring something. I am acquiring something where in turn that will give me a turnaround to my balance sheet. So if you can get that added advantage beforehand, and you can understand that it will be revolving turnarounding that company, 2 years later that company will give decent returns. Huh? Yeah, Ruchi Soya. Patanjali took over it, and from 10 rupees it was 1,000, 2,000 rupees, that kind of thing. So those day-to-day announcements we have to just read, sir. Keep a track of it. Whatever highlights you, whatever catches you, go in deep, learn about it. No need to do any buy, sell, trade, hold culture. Just capture information. For 1 month if you do, you will understand number of companies doing announcements, number of companies make active on announcement, BSE side, they are due diligent, they are compliant. That is also a positive sign. Everything which I am doing, I am reporting to the stock exchanges, one of the positive signs. So if I am doing a takeover, I am announcing. If I am doing a private placement, I am announcing. Something has happened, wrong has happened, a fire accident has happened, I am reporting. Or a strike in employees has happened, I am reporting. So that is a quality of due diligence. Something which we have to see as auditors, most of us are from the CA field. Red flag is something which we can easily catch by tracking. This is the things. Red flag is something we have to see for avoiding the bigger loss. Apart from that, if the company is running in a single day, you will have bigger loss. Only a sudden dip will give you bigger loss, sir. Over a period of time, it will obviously recover. If the company is there and doing business, you will obviously recover after 5 years also. But when the company is not there, like Kingfisher Airlines, something like that, company has gone down, closed up, you are losing your money. So only those things you have to be taking care. That 120 days out of 4,500 days. That is the catch we have to take care, sir. The valuation game. Most of us see valuation by PE, price earning ratio. Price earning ratio is something which is not the only indicator which will help us to get the stock at a reasonable price. Everything has only 3 stages, sir. Good price, good value, undervalued, overvalued. Where do we want to invest? Undervalued or overvalued or a fair price? Undervalued. Only then we will get a return much more than investing at a overvalued things. So this is the ratio where which we help us to understand the P divided by earnings growth. Here we mentioned earnings and incremental revenue. So these two is matching with my ratio. The company is growing in a growth rate of 20% and P is also going on a 20%, which means it is fairly valued. All its gains are been taken over by the price. So today if I want to invest, I am not getting, 1 year back the company was 100 rupees, it has grown by 20%, price has also increased by 20%. So it is as good as buying at 100 rupees only. It is fair value, correct? The price is 115 and the growth is 20. So I am paying only 15 for increase of 20. So I have to buy that. But the price has moved 25 and growth is 20. I am paying extra 5 for 20. So that ratio will be 25 by 20 is 1.25. So I should avoid, because I am paying extra. I could have bought last year itself. Today I am buying at extra. Okay, and if I am getting for 15 rupees for a 20 rupees gain, 0.75, I should buy today. So this ratio will help us to do a value pick. Don't miss any stock. This is specifically which I follow. Don't miss any stock which is fitting in your fundamental list, technical list, and having a peg of 0.5. For gaining 20 rupees, I am paying only 10 rupees extra. That balance 10 rupees will come to me any day. I have to just stay there. So that is a confirmed gain to me. I should just stay. If it is a fundamentally good stock, decently managed, due diligent, I should just remain there. I will get the 10%, which will match my 5% monthly returns. So it is all a combo of things. Small strategies will help you develop a good mindset. With mindset, we can obviously achieve much faster and good return than the average returns. This is something today, up to now we were speaking on the current date, peg ratio, value peg, and this is something which we have to forecast, because we have to invest in a direction of the earnings growth. Next year what the company will earn, then only I will also earn. Okay, so we have to see the forward P, not today's P. How many of you see this ratio? Price is a factor of earning multiple. What is price? P into number of equity shares. That's it. Correct now? So that is the price. Therefore, future price, what will be the future price? Depending on the future earnings. So how you will know how much the company is going to earn next year? Con calls. Okay, annual reports, acquisitions, segment reporting, capex. All those will help you understand that it is going in line with the projections. That's it. Projection has to match with actuals. Once it is matching, obviously company is doing good in their day-to-day activities. We are good at making projections. We are good at comparing actual figures. Every year we should see what the company has said and what the company has done. If it is doing perfectly in 5% variance, we should remain invested. That is hold strategy. If it is doing less than what it has said, please sell it. If it is doing above what it has said, I will grow at 20%, but whereas I am going at 25%, invest more. Okay, sir? So those kind of decision making will come only when you are day to day analyzing the company. It is not by just seeing the price alone. Seeing the price is only tempting us to buy, sell, book profit, book loss. That is a different thing. Whereas investing is much more than the screen which we see. It has to be deep. It has to be more of preparation than just seeing the screen. Company with a low PE. Suppose a PE of the stock is 10% and it is growing only 8%. What will be its PEG ratio? P is 10 and growth rate is 8. 10 by 8, more than 1. So actually P is less. We tend to invest in low P stock because I will get a higher return, but whereas the growth itself is not there and I am paying extra for that company. Overvalued. It is a overvalue. It is a value trap. So only seeing a P will not help us. It has to be combined with the growth ratio. Whereas a company having 60% growth rate, all the technology stocks like TCS or other things will have a PE of 60%, 60 rupees, 70 rupees, and their growth rate will also be very good. So just because the PE is high, I should exit, and PE is low, I should invest, is not the concept anymore. For value pick, it has to be something related to the future profits, future growth rate. We have to focus on those things rather than the current P. Which one, sir? PAT, sir. PAT, sir. PAT. End of the day, that is only the money which is available with the company for bonus, dividend declaration, and self-use, reinvesting. Sales will be growing, sir, but my extra items will be much more, I will not be having all the profits with me. Always better to catch the PAT, sir. That is case to case basis, but on average we should see on a PAT. Yes, sir, that is all those are acquiring major stakes, sir. 5%, 10% stake they will be acquiring. They will be seeing that if they can invest my money, or they are investing with borrowed capital, how much interest they can give, so I will also earn the same only. After 5 years, all the profit will be mine. They are with a bigger capital for a bigger period of time, okay, and when they exit also will not be knowing. Case to case, EBITDA will be good, PAT will not be there, sir. Yes, PAT will be not. But generally, on a general terms, we should compare PAT, sir. PAT will be standard for all, which will give figure helpful for us to ascertain whether it is a value pick or not. Reward comes from conviction and patience. Okay. Today, if someone told me at the end of the session, give a tip. So one tip will help you to gain one trade. But if you can develop your own conviction, out of 10 trades, what is our target? 2:1. Correct, sir? Long term. That's every trade, sir. If I say also one trade, that will help only for one trade, sir. So I will wait for second month also. No, for that only I am taking only 30 trades in 5 years. Exit is also important, sir. Exit is also important. What we are seeing is the return concept, reinvest. That's it. Average we have to see, sir. Average portfolio wise, as sir said, out of my 10 lakhs, 10 companies, some will give me 7-8% return, some will give 2%, some will be 10% minus also. Even an average, if I can get 50% per month, 50,000 per month, it is fair enough. So we have to build our own conviction. Conviction will come only by reading about the company. Whether you invest or not in that company, you are having it in your watch list, please keep reading about that. 1 quarter, 2 quarter, your own conviction will increase. What the company has said, what the company has done. If it is in line, your commitment towards the directors will obviously develop, and you will intend to invest. You will intend to hold. What the company is saying and what the company is doing is inverse, will try to sell that. Not because the price has dropped, because the vision of the people leading has not been deployed in their day-to-day activities. It is not shown in the figures. End of the day, profit matters. I may say I will grow my company by 1x, 2x, 3x, but if I am not giving a report, if I am not getting a profitable balance sheet, no use in investing in that. By words alone, it will not sustain. I should see numbers also. Following the concept of returns, this is something which I am following. It is concept of getting in times than in percentage. If I have invested in a stock, my focus is to get a 2x, 3x return rather than 20%, 30% return in long term. The strategy which I said 5% is for trading. There are two mindsets, sir. Trading, obviously I also do trading. Swing trading is different concept, and for wealth creation, it is a long-term vision. Wherever I am investing for long-term, my vision is only to make returns in times than in percentage. I will not sell if it is 150%, 170%, or even 2x, 3x also. 5x, 10x is the minimum target which we are focusing for 5 to 10 years horizon. So only with that mindset, you can build a bigger portfolio. With the same minimum capital, even if I am having 1000 shares at 100 rupees, I am invested only 1 lakh. but my returns matters, my CAGR matters. Somebody invested 1 crore and I've invested 1 lakh. My return is 1x. I'm earning only 1 lakh. And for the other person having 1 crore capital, if he earns 1% also, will match with my 1 lakh 100%. So that is uncomparable. What I'm focusing is on the percentage of gain which I can get from my capital. CAGR is something which will give your own report card rather than seeing for the bigger capital size, gaining the amount equal, but percentage wise he has earned only 1% and I have earned 1x. So I should be more happier than the other person. Patience and continuous learning is the key to create wealth in stock market. These are the few books which I follow. The Intelligent Investor, the Compounding Effect. This is something which will help you to understand the power of compounding. Japanese Candlestick. This is something where it will help us to capture the technical stock. We all are good at fundamental analysis, but generally we intend to, we are lacking technical stocks. So this is a book where all the candles, hammers and other things are explained beautifully with charts and diagrams with live examples. So this is a book to follow. And companies announcement, newsletters, investment con calls and companies interview with other investors. This is the capturing point where you can get the database, put it in our watch list, follow in our 20 to 50 companies, filter those companies which are not giving reports, gain momentum or gain focused understanding on the companies which are we are having a bigger convictions and add on those convicted stocks. This is something which we should do quarterly or half-yearly. We have to evaluate our portfolio now and then. Evaluate is not just by seeing, it is by whether we should buy, sell or hold. And generally, as we started early, it is selling at a smaller profit and not selling at a smaller loss. I am buying a stock at 100 rupees, I intend to sell at 110, 120. If in 1 year, if I get 20%, I will sell. But it is 80 rupees, I will not sell and I will continue to hold. We should learn to digest the profit. 20 rupees is also mine, I will continue to hold. This is something which we need to develop. Most people miss to digest the profits. We stop at small profits, bigger profits we are unable to see. We don't stop at smaller loss and we see bigger losses. This is a concept of leverage. Okay, simple concept. Get at a lower rate of interest, invest in a higher rate of interest. It is not first principle to invest in equity. It has to be our own funds. It should not be with borrowed funds. I should not borrow at 12%, okay, and invest in equity market. Not suggested. Out of my income, after going my expenses, I should invest. That has to be the fundamental and the first principle. This is a concept where on a day-to-day activity, I have a housing loan. Okay. In a housing loan for 20 years pattern, the total amount of 50 lakhs loan, we pay 50 lakhs equal interest in 20 years. But when we see the chart, first 5 years, we will pay 15 lakhs interest and next 15 years we will pay only 5 lakhs interest. Major interest portion is been taken in the first EMIs than in the last EMIs. Okay. So if I wish to repay faster, should I pay earlier in my loan terms or I should pay in my 18th or 19th year? First or second year, if I have excess fund, I should pay in my EMIs first, advance EMI. 12-month EMI is there, I should pay 2 months EMI excess or bulk amount in excess, because that will help me to pay less interest over a period of time. The same concept, I am on my 15th year of EMI. Okay, even if I pay 2 EMIs extra, I still have to pay 48 months. But those 2 months, if I pay excess in my second or third month itself, it will help me gaining 12 months EMI, saving my 12 months interest. So when I'm in my 10th year or 15th year of my repayment of EMI, I will not repay my bank. I will invest in a 18% return composite. So a leverage of 10% will help me gain handsomely. So 10% is much more than simple our debt fund returns. Anything is okay, sir. 1% is also okay. What we do in our SB and sweep account? Home loan, okay. FD also. No sense, sir. OD against FD. Safety, yes. But to me, if that is the case of having a 9% FD and paying a housing loan of 8.8 or 8% also, I will believe to close the EMI at the earliest. Whatever, sir, tax, that is, but if you are in the early stage of your EMIs, close your FDs, pay your EMI. If you are on the 10th year, 15th year of EMI, then it is no use, sir. Okay, sir. Extra amount, yes. EMI will change, yes. Investment, yes, sir. You start SIP. That is one more concept, sir. EMI, suppose it is for 50 lakhs housing loan for 20 years, EMI will be 50,000. Okay. And for 20 years, we will be paying 1 crore, 50 lakhs principal, 50 lakhs interest. At the right from the day, first month of the EMI repayment, put a SIP for 10,000, sir. 60,000 will be outflow. At the end of the 20th year, you will have a corpus of much more than what you have paid the interest. So your 50 lakhs interest is also recovered, and you will still have the surplus. So you have to work 20% extra for getting back your interest what you are paying for your housing loan. Small things will make a bigger difference in long run. Anything? This is something today when most of us are fully invested. We say, I don't have cash, I don't have bank balance, my portfolio is fully invested, I should only sell to reinvest something, which I actually didn't intend. I should not sell my Reliance to buy another stock today. Okay, I am in that position and I don't have new funds. Still what I do is this thing. I keep the hunt on. Okay. Even if I don't have funds or fully invested, keep the hunt on, because you will, when you have the funds, you will not have the eagerness to find that gem. Suppose today somebody gives you 10 lakhs. I am blank, sir. I have left the market 3 months back and I am not aware of the day-to-day things, which stock is doing good, which is the catch I should take. I don't have money, I am not seeing the market. That is a different strategy. Assume that today I can get 10 lakhs from someone else, a old repayment of loan has come to me, or sudden funds have been released, old debtor has come back to me, something like that. Those extra amount, are we ready? Opportunity comes to prepared mind. So we are preparing ourselves. It is a continuous preparation. Risk reward, everything will match, sir. Only thing is, just because I don't have funds, I am not reading. I don't have exam, I am not reading, sir. Only when my exams are there, I am reading. It is something like that, sir. Tomorrow is my exam, today I am reading, sir. But on a regular day, if you read for 1 hour, your not just your exams, for your lifelong, you will be having a good backup. So something it is like that, sir. So any side income which I said, suddenly you are getting 10 lakhs extra. So those extra income should be used for investing. For youngsters, this is the thing. If you are getting extra income today, your average income is 20,000 and you are investing 10,000 a month. Okay, suddenly you get 10,000 extra income in 1 month. Okay, that 10,000 you should not go for spending, rather go for investing, because that 10,000 will make a bigger amount in 5 years, 10 years. Okay. Time will give you, time in the market is much more than timing the market. Continue to be invested, you will get much more returns. Opposite of that, today I have 10 lakhs. Tell me where to invest. Market is at peak, all the stocks are having good high value. Where to invest, sir? Please remain just silent, wait for the good opportunity, wait for the market to fall. Okay, we need not trade when we have funds, sir. Both the things. When we don't have fund, we have to continuously watch the market. When we have funds also, it is not necessary we should invest. Just remain patiently, watch the market. Whenever we are getting a chance on a watch list, this is the pick which I want to buy, collect that, coordinate that and buy on that funds. Just because I have 10 lakhs, I should invest tomorrow is not something good, because we are paying extra. The gain which we are anticipating, we are already paying extra, then there is no point in investing. That is okay, sir. That is like 2%, 5% gain if you want. That is different thing. Purely on market, sir, which I actually didn't want to buy. Just because I am having funds, I am investing. Those are parking. What you said is mutual fund for 10 days, sweep account for 10 days. Those are parking value. A 2% gain is also beneficial. That will give my extra income for all my day-to-day expenses. Those are different strategies where we can have a leverage. This is also a leverage concept. I am keeping money in my current account, whereas I am getting 2 or 5% extra. So that is a leverage concept. How many companies you can read, sir? No, how many companies you can follow and read? Simple thing, sir. You can have 100 also. Only thing is 100. Yes. But better is to have less number of stock so that our focus is more. Same the ratio which I gave partnership firm. If my ratio is more, I will give more time to it, rather than everywhere if I am investing 1%, everything is same to me. If I invest 20%, 30%, I will have more keen thing to it. Sir, mutual fund, sir. The power of mutual fund, sir. Okay. For early birds, the people who are starting now, this is something, if you don't understand market, like I cannot pick a company, I cannot follow a company. This is a standard thing which you should do consistently right from your age, 18 itself. Once you start earning, minimum 20% of what is your salary or what is your monthly pay, you should start investing blindly in mutual fund, because getting knowledge about bullions, real estate will at least take 24, 25 years. Today you are only 18. So first 5 years, just learn the art of saving and investing, and this is the best platform, mutual funds. So how SIP works, it is like planting a seed every month for a forest tomorrow. Every month I am putting SIP. After 10 years, 15 years, I will have a good corpus. While working, keep adding monthly SIPs. For SWPs, for seniors, I have already invested in 30 years of SIPs, mutual fund. Today, I should enjoy that money, which I am telling. After 50, 60, I should enjoy the money which I have developed. So it is SWP, remaining investor on a withdrawal plan. It is growing at a 15% return. My mutual fund is growing at 15%. I am withdrawing 7% of my corpus. My corpus in mutual fund is 10 lakhs. Okay, it is growing at 15%. 1,50,000 is the gain, and I am withdrawing 70,000 every year. So I am enjoying my part also, and I am remaining invested also. That is a SWP concept. Once a corpus is developed, a mixture of both can be done. And here we use the mind of the professional fund manager. Okay, everything we need not know, everything we cannot know also. Okay, we are using the services of the professional fund managers. They are on a day-to-day activity managing 500 crores, 1000 crores, 10,000 crore portfolio. They will obviously give much more returns. They will have an informed decisions making power than us. So we can have a certain part of our portfolio sizing in mutual fund also. This is something which I believe we most of us lack. It is like consulting a friend or a professional. We believe that I have chosen a company, it is very good, I will straight away take the decision and I will invest. It is something like we don't consult. We don't consult, sir. If I have fever, I will go to doctor and consult. Okay. If I have any other problems, I will go to lawyer. If I have any family problems, I'll have someone to talk about. But for investing, we generally don't share our investment details. He will have envy on me or those things. Have at least 2 or couple of friends where we can openly share our victories, and it is he or she also assume that I am winning. If you are investing, I should be as joyful as him, that yes, please do so, it will be good for you. Develop couple of good friends like that over a period of time. Talk about your investments, so that will give you a developed, informed decision making. I may know something, you may know something. Only when I talk to you, you will give me another point of view. So it is like your strategies and action plans. Talk to your friends or fellow investor, bounce ideas, challenge assumptions. This collaborative and cautious mindset helps a continuous improvement and better decision makings. These are the key takeaways. There is no one size fit for all investments. Something may fit for me, something may not fit for you, something may fit for you, that same thing may not fit for me. In a longer run, each one has to do his own design of the investment strategy. These are the various strategies which I have been following, which has fitted me. There are various other options also, which I may not know and I have not used it, which may be useful to you. Then only by discussion and sharing thoughts, we both can gain. So this is something which will not fit for all. Regular review, rebalancing your portfolio is essential. This is on a regular intervals. We should keep doing this. Early start, stay disciplined, and match strategies with your life goals, which were your SMART goals. Okay. Thank you all for the patient hearing. If anything, we can take up the questions, sir. Yes, sir. Yes. Which one, sir? Please. IPO.
Yeah, is there any strategy to get successful allotment of IPOs?
No, sir. Invest in pre-IPOs. Invest in unlisted companies, sir. If you are very keen on investing in getting allotment, sir, and we are well aware, like the recent IPO NSDL, when we are very much sure that it will subscribe at least 50x or 100x and we will not get IPO allotment, please invest in unlisted space. Valuation is different, sir. When we are today, that's what, sir. Favorable risk reward we have to see. If you are very keen on getting the allotment, today is a different market where you can invest much before than the IPO itself, and we specialize in that, sir. In last 5-10 years, we are being investing in unlisted shares. Okay, listed shares also we do, but this is a scope where it has been very less known. Today it is much more familiar for all of us to what is unlisted shares, and we have been doing it since 2016, investing in equity of startups, quality NSE we have invested long back, NSDL we have invested long back. So catching a quality stock at a favorable price, we need to be ahead of others. So when we are not getting allotment, we have to pay extra charges, sir. That's it. After listing, you are paying extra.
Yeah, that's what I am asking. If we bid for some larger amount or larger quantity.
Nothing, sir.
any
It is
chance
all algo based, sir. It is based on the application you make. It is on a standard algorithm. Out of 50 application, one will get allotment. Suppose you are doing 50 applications. It is not necessary that out of your 50 you will get one, sir. In my 50 I can get 2. You may not get 1 also. So it is purely algo based selection of the application, sir. It is no more manual, and if it is so, it can be reported easily catched by SEBI. Today it is not manual. It was way before 2010 when all those allotment setups was done. In 90s it was very easy. Up to 2011-12 all this could have been done, but today I fairly don't think it is possible, sir. To get a IPO allotment, it is not so easy.
Also, it is advisable to participate in IPO through QAPs.
Yes, 100%, sir.
QAPs,
Huh?
Quality institutional buyers. Is it advisable?
It is not that every IPO has to be applied, sir. Today, when we have there are couple of sites which gives us IPO premium, grey market premium, and we can have advanced learning on the companies. Today, NSDL is obviously known much more before than listing. So it is not the company which we are learning today. We are seeing as a depository from last 20-30 years. We are confident about the company. We are learning about we are visiting the branch every day and out about delivery. So it is a quality stock which is there for 20 years, profitable stock. So we should apply for those kind of companies. There are new ages companies which are going to specialize in a market. Like there was a drone company, there was a aviation company. Today it got listed, Fly SBS. So these are something which will change the sector itself. 100% we should invest in those companies. And there are companies which are regular. There is a plastic company having a molding structure, doing a production of a shape and something like that. Those are ample number of unstructured firms also. So that will not give a bigger market cap in long run. So even if you invest in those kind of company, please exit in listing gains. Quality businesses, quality long run businesses stay invested, and X factor companies like Fly BS, which are going to develop the aviation industries, private jets they are bringing. Today it was like going in a train took 4 days to Delhi 20 years back. Today it is matter of 4 hours from this destination to a meeting hall in Delhi also, including all the travels. Okay, so when the industry is developing, today I want luxury. I want to travel in helicopter. I want to take my friends, 8 friends for a trip in a private helicopter or a private jet. People are lavishly spending. So obviously these kind of companies spendings will happen from individuals, and those companies will gain. Only thing there we have to say is the sustainability and the due diligence.
Thank you, sir.
Yes, sir. Which one, sir? Which website, sir? IPO premium, sir. Screener is something best which gives all kind of comparison of ratios, updates. I follow Stock Edge, I follow Economic Times, I follow Money Control Pro. Most of the apps I am subscribed to it because I get information beforehand, and I am very much interested in learning beforehand, sir. So after comparison, I take my decision. So it builds my conviction, sir. Anything else? Thank you so much, sir.
Thank you. Thank you, sir. You have given a overall picture of how to make investment and make money on the stocks. It is my advice to the young people, out of their pocket money expenses, they should try to invest in stocks or in mutual funds. 100 rupees, 1000 rupees, 500 rupees, that will help them in the long run. And most of the investments, if you want a best return, you have to keep the return for 7 to 10 years, not at short term selling and buying.
Yes, sir.
This is my advice to you. See, the advantage of investing in equities is while you are sleeping, you will earn some profit. See, the company will make some charity, a portion goes out of your own money. That you should think. And another thing is, you should also view the economic development of the country. And for the future, the transportation industry is going to grow, ship transportation is going to grow, tourism is going to grow. When tourism grows, related industry also will grow. Please use your mind to invest. Thank you.
Thank you so much, sir. Experience speaks, and how we evolve around the time, how economics grows. Today, India is becoming a tourist country. Obviously, tourism is my trip, and correspondingly, all the hotels, all the resorts will gain good profit. Taj is there, Chariot, the Marriott group. Obviously, they have given quarterly results is more than 80% growth. So when those kind of growths are there, obviously you should buy those and continue to hold those kind of stocks. So it is depending on the economic sector with the company's results. We have to match the shift and continue to be there. When there is a downfall in the sector, like today nobody is visiting India, for example, we should see the growth rate. If still it is continuing to grow, we should remain there. If it is also growing, declining, we should exit. Those kind of reports and analysis will help us to take better decisions. Thank you once again. Thank you all.
So, thank you, sir. On behalf of SIRC, once again, I thank you, sir, for taking your time and being with us today. I also thank all the members for attending this session and making it a success.